That feeling, you know the one I mean. The absolute rush when you see your investments just climbing day after day. You could feel like a genius, right? Like
Right?
money's just
I agree.
easy.
Absolutely. That euphoria.
And then that horrible drop in your stomach, that gut punch when everything starts falling apart, maybe wiping out months, even years
Yeah.
of gains.
It's the financial roller coaster.
Exactly. And if you've been in the U.S. markets for, say, the last 20 years or so, you haven't just read about it, you've lived it. You've been on that ride.
It is definitely a journey, isn't it? Packed with those highs, but honestly, often the really deep learning happens during the tough times, the downturns.
You got it. And that specific roller coaster, your financial journey over these past couple of decades, that's exactly what we're diving into today. We've got this great collection of sources you shared, articles, market letters, even your own personal reflections.
Yes, charting this path, specifically looking at U.S. market cycles over that 20-plus year time frame.
So think of this as like your personal guided tour through the terrain you've already walked. Maybe helping you map it out a bit better, understand the forces that were pushing and pulling you along the way.
Right. Our goal here, using all this material, is really to help you make sense of your own experience through these pretty turbulent times by looking back at the big market events you lived through.
Identifying those recurring patterns, the insights that pop up again and again in these sources.
And pulling out the timeless lessons hidden in that history. We want to give you a clearer lens on the journey you've taken.
Okay, let's get into it. So where does this 20-year journey really kick off, according to these sources? It seems like right at the peak of, well, some pretty major optimism, late 90s, early 2000s.
That's right. That era, as the AMM source really paints vividly, was just drenched in optimism. They mentioned starting their firm back in '99, just months after that. Well, now, infamous book came out. DOW 6000.
DOW 36,000. Yeah, that's become almost a code word for peak market hype, hasn't it? The author is writing when the Dow was, what, around 11,000?
Around there, yes.
And they basically said it was undervalued and was going to triple, hit 36,000 in just like 3 to 5 years. They were targeting 2002 to 2004, I think.
And of course, the AMM source, looking back from 2019, points out the slightly different reality. The Dow was still about 9,000 points short of that target, a full 15 years behind schedule.
Wow. 15 years.
It really stands as this potent reminder, maybe a cautionary tale, about the kind of, well, irrational thinking that can grip markets during those super optimistic phases.
And it wasn't just book titles, right? The actual numbers, the valuations reflected that optimism. The AMM letter talks about the KPE-PE ratio, the cyclically adjusted one, for the S&P 500 back in 1999.
Correct. And that ratio, which smooths out earnings over 10 years to give a better long-term valuation picture, was trading more than 2 standard deviations above its historical average.
2 standard deviations, so statistically speaking, that's rare.
Extremely rare. The source is very clear, calling it as sure a sign of overvaluation as the stock market has ever seen. It's like the market was screaming expensive in quantitative terms, a major red flag.
So imagine starting out in that kind of environment. The personal journey source you shared mentions beginning in 2006. Okay, so that's after the absolute tech peak. But it still sounds like it captured that feeling of, easy gains.
Yes, the source says pretty plainly, in that period, the opportunity to make a profit was quite easy.
And the initial approach described, it's quite telling.
Very. Having no real method, just buying, say, random preferred stocks. It wasn't about disciplined analysis, but because there were maybe fewer investment options easily available than for retail folks, and lots of cash kept pouring in.
Pushing prices up anyway.
Exactly. So it felt simple to make quick profits.
And the conclusion drawn, according to the source, was earning money in the stock market is really simple. Just buy and you will make a profit.
That dangerous simplicity. It's exactly what that kind of environment fosters. You feel smart, you feel like you've got it figured out because everything's going up.
You mistake the bull market for your own brilliance.
Precisely. But as market history always teaches, often the hard way, those easy money periods don't last. They're just peaks in the cycle.
And then comes the downturn. The AMM source talks about the tech bubble bursting, stocks falling nearly 50% from the 2000 highs by late 2002.
Yeah, a huge drop. And it wasn't just the market correcting itself in isolation. It was hit by that double whammy, as the source calls it, of 9/11 and the recession that followed.
Right, those external shocks just piled on the fear and uncertainty.
Absolutely.
Now, this connects to that personal journey experience you shared. It mentions the market declining sharply starting in early March 2007. Okay, so a bit later than the tech bust peak, but it marked a significant local peak within that specific investor's timeline.
And then the decline really deepened from October 2007, rolling right into the big one, the global financial crisis. The source describes watching stocks just plummet 10%, 20%, 30%, 50%. Your accounts just evaporated day by day.
Oof, that sounds visceral.
It delivers a very harsh lesson. The source pinpoints it. Investing in stocks is not as easy as I once imagined. That initial, simple, maybe even naive approach, combined with the luck of starting in an upswing,
Led to complacency.
which the market then punished. Swiftly and painfully. It's a classic story.
So after that first major shock, the sources mention a brief recovery, right? Kind of a breather before the next storm.
Yeah, the AMM letter calls it a mini bull market running from 2003 through the fall of 2007. He gave people a bit of a break, maybe even started to rebuild some confidence.
A bit of a head fake, perhaps.
You could definitely feel that way in hindsight. Because right after that,
Became a really big one.
exactly. The second, and many would argue much more damaging, collapse of that decade. The great financial crisis, the GFC, triggered by the housing bubble bursting and the deep recession that followed. Stocks fell again, even more this time, over 50% from the highs by March 2009.
And that whole period earned that awful nickname, the lost decade.
Yes, the AMM source gives that staggering statistic. By December 2009, if you'd invested in the S&P 500 10 years earlier, your annualized return was actually negative 1%.
Negative 1%. Over 10 years, you could have just held cash and done better. That's brutal.
It really drives home the destructive power of these major bear markets. And investor sentiment at the absolute bottom, around March 2009. The AMM letter says it could not have been worse.
People were just terrified.
Completely. The focus shifted entirely to safety. The hot investments weren't about making big returns. They were about, as the source puts it, a return of capital, not a return on capital. Just get my money back, please.
So extreme conservatism took over, even ignoring low interest rates and, well, stocks must have been incredibly cheap by then.
Dirt cheap by historical standards. But fear trumped valuation. People were flocking to alternative assets too, like hedge funds, hoping for something uncorrelated to stocks, even with high fees. Anything to avoid that stock market pain again.
And honestly, after living through two 50% plus crashes in less than 10 years, you can kind of understand people being gun-shy.
Absolutely. The fear was real. The instinct to just protect whatever was left was totally understandable.
And this is the crucial insight that comes out of this period, isn't it? That very moment of maximum fear and rock-bottom valuations, that's where a core principle really shines through.
Yes. The AMM letter puts it so clearly. If market history teaches us anything, it is that future returns are higher when starting valuations are low and lower when starting valuations are high. That despair in 2009, paradoxically, was setting the stage for the incredible bull run that followed. Low valuations mean higher potential future returns.
Okay, so we've walked through the euphoria, the crashes, the lost decade, the lived experience. But just living through it isn't enough, right? To navigate better next time, we need to understand why these cycles happen, what's actually driving them.
Right. And this is where sources like Howard Marks' insights, discussed in the We Study Billionaires material, are so valuable. First, just defining the cycle. The AMM source calls it a continuous wave that rises, peaks, then falls, eventually troughing and then rising again, talking mainly about asset prices.
Stocks, bonds.
Exactly.
Mm.
But it's clearly linked to other cycles too. The economy, credit, housing, they all feed into each other.
And why bother studying these cycles? If they're inevitable, why not just write them out?
But Marx makes a compelling point. Studying cycles matters because your odds of success change dramatically depending on where you are in the cycle.
So being passive, ignoring the cycle,
Means you're giving up the chance to tilt those odds in your favor, according to Marx, like sailing blind, ignoring the tides and the wind.
Okay, so what's the engine behind these waves if it's not just random?
Marx is really clear on this, and it's a recurring theme. It's largely driven by human psychology and behavior. It's less about the pure numbers and more about how we react to those numbers, to events, to each other.
So because it's human-driven, it's not perfectly predictable like, say, a clock.
Exactly. Marx uses a baseball analogy. A great hitter's performance isn't just math. It's their skill plus health, weather, the pitcher that day. Countless unpredictable things. Markets are similar. Fundamentals matter, but so do politics, technology, random shocks, and crucially, how millions of people feel about it all.
And people, as Marx notes, tend to swing to extremes. We don't often just hang out in the middle.
Which leads directly to his fantastic pendulum analogy. He says the market swings not between average and extreme, but constantly between two poles, euphoria and depression, celebrating only the good news versus obsessing only over the bad, which leads
That's
to
overpriced versus underpriced markets.
precisely. And the critical point is the pendulum spends very little time near the middle, the happy medium. It's almost always swinging hard towards one extreme or recoiling back towards the other.
And the swing itself creates the energy for the return swing.
That's the fascinating part. The further it swings towards euphoria, more confidence, more borrowing, higher prices, the more potential energy builds up for the inevitable, often sharp swing back towards fear and contraction.
Marx also lays out some fundamental truths about cycles we need to remember. First, they're inevitable. You can't escape them.
Yep. Trees don't grow to the sky, and few things go to zero, as he says. We have to fight that, this time's different urge. It's almost never different in the big picture.
And their impact, it's amplified because we forget the past, right? Or maybe haven't lived through enough cycles.
Exactly. Amnesia is a powerful force in markets. And another key point, cycles are self-correcting, meaning trends contain the seeds of their own reversal. Huge success and optimism, like easy credit fueling a boom, sow the seeds of failure, too much risk, bad loans. Conversely, failure and pessimism, like a crash-forcing discipline, sow the seeds of the next success. Cheap assets, survivors are stronger.
Interesting. He also points out how we even talk about them differently. Downswings or volatility or panic sounds bad. Upswings are just profits, sounds normal.
Yeah, there's a perception bias. And while they swing up and down, they aren't always symmetrical in how fast or how far they go. The old saying holds, stairs up, elevator down. Gains can be gradual, losses sudden.
And because these underlying themes repeat, Marx argues it's more important to understand the themes than the specific details of each crisis.
Right, like the GFC, the key takeaways weren't just subprime mortgages are bad, but the timeless themes. Excessive optimism is dangerous, risk aversion disappears at the worst times, and too much easy money leads to trouble. Recognizing those themes helps you spot the next bubble, even if it looks different on the surface.
Okay, so psychology is huge. What about the underlying economic fundamentals, the business cycle?
That's the foundation, as Marx describes it, measured by GDP growth, oscillating around a long-term trend. That trend itself is driven by things like population growth and productivity gains.
And he mentioned back in 2018 that U.S. growth seems slower than in the 90s. Was that just a cycle dip or a long-term shift?
That's the million-dollar question, isn't it? The Saigon Times source actually touches on this debate. It suggests maybe the classic business cycle isn't quite the same now. Recessions seem shorter, growth periods longer. Why? Maybe the shift to a service economy, global trade, smoothing things out, and a big one, government and central bank intervention trying to manage the swings.
The role of the Fed and the government,
Yeah.
trying to smooth things out.
Exactly. Marx and the Saigon Times source both talk about this. The Fed has its dual mandate, low inflation, low unemployment.
And they use tools like interest rates.
Interest rates, quantitative easing, QE, influencing government spending and taxes. Their goal is to be counter-cyclical, lean against the wind, basically, cool things down when they overheat, stimulate when they slump.
But Marx also adds a dose of reality. It's hard even for them to know exactly where we are in the cycle.
It's incredibly complex. But then there's another cycle Marx really emphasizes, maybe even more than the economic cycle for investors.
Which is?
The credit cycle. He calls this the most volatile cycle and the one with potentially the greatest impact on asset prices.
Okay, explain the credit cycle.
Think of it like a tap for borrowing money, the credit window. When times are good, the window swings wide open, lenders feel confident, they compete for business, rates are low, standards get looser, money flows easily.
Sounds great, but
But it often leads to unwise lending, too much debt, too much risk. Eventually, losses start to appear. Lenders get scared, they pull back, tighten standards, demand higher rates. The credit window starts to slam shut.
And that has big consequences.
Huge. Businesses need credit for everything. Operations, growth, just refinancing old debt. Financial institutions depend on it. When credit dries up, it can cause a cascade. Fear spreads, businesses fail, investors face margin calls, and are forced to sell assets into a falling market. It can turn a correction into a crisis.
So the credit market is like a barometer of market fear or confidence.
Marx sees it as a great indicator of market psychology. And crucially, he argues the state of the credit cycle, tight or loose, is a major factor determining whether investment bargains are plentiful or scarce.
Okay, let's bring this back to the personal journey, those early losses we talked about. They weren't just painful, they were a catalyst, right? They forced a change.
Absolutely. The Vietnamese source is explicit. That shock of seeing accounts evaporate led to digging deep, studying successful long-term investors, people like Buffett, Philip Fisher.
And realizing that the initial approach, the simple buy whatever's going up trading, it just wasn't sustainable.
Right. It needed a fundamental shift in philosophy, moving from just trading prices to actually investing.
So what were the key lessons that emerged from this study and reflection?
Several crucial ones. First, and maybe the biggest shift, understand the business. Stop focusing just on the stock ticker and chart. Dig into what the company actually does. What's its core business, competitive advantages, growth potential, and importantly, are there potential profit triggers coming up?
Profit triggers? Explain that again. So a good company isn't always enough.
Not necessarily for a timely investment gain. A profit trigger is some specific identifiable event or change a new product, a regulatory shift, a restructuring, selling off an asset that's likely to significantly boost profits or change how the market values the company. Identifying these helps you build scenarios and know why you expect the price to move rather than just hoping.
Makes sense. What's lesson number 2?
Respect market cycles. Accept they exist, these ups and downs. You can't predict them perfectly, but you need to factor them into your strategy. The goal isn't just profit maximization in the upswings. It's equally about protecting your capital during the downturns. Investing is a marathon, not a sprint. You have to survive the bad times.
And lesson 3 sounds tough, but necessary. The wisdom of cutting losses.
Emotionally very difficult, but strategically vital. The source calls it the smart choice. Why? Because preserving capital is everything. Only by keeping money can you earn money in the next upswing.
If you hesitate, you get stuck holding losers.
Exactly. You tie up capital, maybe for years, in something that's not working. And worse, you have no cash left to buy the great opportunities that inevitably appear at low prices when the next upswing starts. It's about staying flexible, keeping your powder dry.
Okay, and the 4th key lesson.
Recognizing that the market's reaction ultimately matters. Your analysis could be brilliant, but if the market doesn't agree, at least in the short to medium term, you can still lose a lot of money. The source warns against being too stubborn, fighting a strong trend driven by collective greed or fear.
Because that trend can last longer than you can stay solvent.
Precisely. That collective emotion, even if irrational by your lights, can be incredibly powerful and persistent.
You know, this idea of respecting the market's reaction reminds me of Randy McKay's philosophy, mentioned in another source, the trader.
Yes, there's a strong parallel. McKay wasn't trying to predict global events. He focused intensely on how the market reacted to news. That was his primary signal.
And his emphasis on finding a style that fits your personality, being flexible with position size, controlling risk obsessively, and getting out fast when wrong.
It all aligns beautifully with the lessons from the personal journey. Both point to success being a combination of solid analysis, understanding market psychology, including your own, and disciplined risk management. It's internal stability meeting external reality.
So with these lessons learned, how do you actually put them into practice? How do you respect the cycle in real terms?
Well, it leads to what the AMM letter calls active asset allocation. It's not about having a crystal ball.
No perfect timing.
No. It's about understanding the current environment. Is sentiment generally fearful or exuberant? Are valuations broadly cheap or expensive? And then adjusting your portfolio accordingly. More defensive, less risk when things look frothy near highs, more aggressive, taking on more risk when things look cheap near lows.
But AM admits this isn't easy, right? You can be wrong.
Oh, definitely. They're clear about the potential for error. You might get defensive too soon and miss out on more gains. You might get aggressive too early in a downturn. But their point is, it makes no sense to have the exact same portfolio allocation when stocks are historically cheap versus when they're historically expensive. You have to acknowledge the cycle somehow.
And the personal journey source gives some concrete examples of applying this new approach, right? Moving beyond random picks.
Yes, specific investments based on understanding the business, identifying those triggers, and assessing valuation. Like the GAS investment in early 2013.
What was the thesis there?
It wasn't just buy an energy stock. It was identified as having a near monopoly in its gas niche, and crucially, trading at a low PE ratio about 7.5 times earnings relative to strong profits. Good business, attractive price.
And they held it for a while.
Until mid-2014. And the exit wasn't panic selling. It was based on a changing industry outlook. falling oil prices due to slowing China growth, and OPEC refusing to cut supply that fundamentally changed the earnings picture for GAS. So they adapted based on evolving sector fundamentals.
Okay, another example.
PHR, early 2017. The focus started on rubber companies, but then zeroed in on a specific trigger at PHR. They had lots of old rubber trees. At the same time, China banned logging, which spiked demand for rubber wood in Vietnam.
Ah, so the old trees suddenly became more valuable for their wood.
Exactly. And PHR had a clear plan to liquidate these trees, sell the wood at a large scale, like 1,000 hectares a year. That, plus expected money from land compensation. You had multiple overlapping profit triggers lined up. Very specific analysis based on company assets and external factors.
And the third example, NDN, in early 2018.
That was more of a balance sheet and valuation play, observing strong sales from a key real estate project, but more importantly, seeing cash reserves piling up rapidly on the balance sheet.
Low debt, lots of cash.
Very low debt.
Yeah.
The analysis calculated cash per share was actually getting close to or even exceeding the stock price, which was trading between 10,000 and 13,000 VND share, while cash per share hit over 21,000 VND.
So you were essentially buying the cash and getting the real estate projects for free.
Pretty much. A huge valuation disconnect. Plus, the profits from finishing the project would boost equity further. It showed deep analysis of financials and project status, leading to finding an undervalued situation. These examples really illustrate that shift to a deliberate, analysis-driven approach.
Okay, let's circle back to the GFC. Living through an extreme like that really hammers home these lessons about cycles, psychology, and especially risk, doesn't it?
Absolutely. Marx really digs into the cyclical nature of risk perception itself.
What does he mean by that?
It's this crucial, counterintuitive idea. Risk is usually highest when people think it's lowest during periods of peak optimism and complacency. Everyone ignores potential problems. Conversely, risk is often lowest when people think it's highest during peak fear and pessimism, because prices have already crashed and reflect terrible outcomes.
So the most dangerous belief is thinking there's no risk.
That's exactly what Marx warns. That's maximum vulnerability.
And he saw the GFC as the ultimate example in his career.
Yes, the biggest financial storm he'd witnessed. He stresses it was primarily a financial phenomenon driven by that easy capital, lack of prudence, complex derivatives nobody understood, lenders selling off loans so they didn't care about quality, and just sheer greed.
And this is where that Buffett quote comes in, the one Marx lives by.
The less prudence with which others conduct their affairs, the greater prudence we should conduct our own affairs.
Meaning, be more careful when everyone else is being reckless.
Exactly. And the flip side, have the courage to be more aggressive when everyone else is panicking. Act countercyclically.
Marx shares Oaktree's own tough experience during the GFC, doesn't he? Even though they thought they were being careful.
Right. They used leverage, but less than others, maybe 4x equity versus 7 or 8x elsewhere. They focused on senior loans, supposed to be safer. They figured these loans wouldn't drop below 96 cents on the dollar, and their margin calls were safe above 88 cents.
But after Lehman collapsed,
all bets were off. Panic was so extreme, even those safe senior loans plummeted to levels nobody thought possible. It triggered their margin calls.
Forcing them to
raise more capital from investors twice, right in the depths of the crisis, just to reduce leverage and avoid being forced sellers at terrible prices. A brutal, stressful time that showed how quickly safety can vanish in a true panic.
And he tells that story about the pension fund meeting.
Oh yeah, that perfectly captures the mood at the bottom. This investor was just consumed by fear, fixated on potential losses, using wildly pessimistic, even unrealistic assumptions, completely blind to the incredible bargain sitting right in front of them because fear warped their perspective.
And Marx's response was basically, if you're that scared, you shouldn't own any stocks.
Pretty much. His point was their fear level was so extreme it made rational thought impossible. They couldn't see opportunity, only risk.
So what's the big lesson from these extremes?
It's just incredibly hard psychologically to do the right thing at the bottom, to buy when your gut is screaming sell. That excessive risk aversion makes people focus only on preventing more loss, missing the generational buying opportunities that are being created by that very fear.
When everyone thinks things can't get any worse,
prices have often fallen so far that logically the risk of further permanent loss is actually quite low compared to the potential upside. That extreme pessimism, like Marx saw in that pension fund meeting, is often a sign that optimism has been completely wrung out, potentially signaling a bottom.
And this is when value investors really step up. Marx wrote his Limits of Negativism memo then,
arguing counterintuitively that extreme skepticism should actually breed optimism.
Yeah.
And he put his money where his mouth was.
Buying those depressed senior loans when nobody else would touch them.
Exactly. And it became one of Oaktree's best investments ever. The market's fear created absurdly cheap prices.
This ties right back to the credit cycle extremes, doesn't it?
Perfectly. Mark says the absolute best time to invest is usually when that credit window is slammed shut. Lenders are terrified, capital is scarce, defaults are rising. It's painful, but that's what creates low prices, high potential returns, and surprisingly lower risk, because so much bad news is already priced in.
High-risk premiums, too, right? You get paid more for taking perceived risks.
Yes, that slam-shut phase creates bargains like nothing else. Conversely, when credit is easy, FOMO is raging, standards are low, that's when you get high prices, low future returns, and high actual risk, even if it doesn't feel like it at the time. Understanding that credit cycle is paramount for Marks.
Okay, so we've covered this incredible journey, the historical ups and downs, the forces like psychology and credit driving them, the lessons learned, especially from extremes like the GFC. How do we tie this all together to make sense of, well, today and whatever comes next?
Well, the first thing is acknowledging that cycles haven't stopped. We've seen plenty of volatility in recent years, right? The sources mentioned the strong returns post-GFC, like 2019, then the wild ride of 2020, 2021, the drop in 2022, recovery in 2023. Returns keep swinging wildly around the average. Cycles are alive and well.
And the sources even bring in some more recent expert takes. From April 2025 via the CAFF source, what were they saying then?
Experts from big players like BlackRock, Goldman Sachs, they were highlighting potential pressures, things like ongoing trade tensions, worries about a U.S. recession picking up steam.
And signs of a potential bear market.
Yeah, noting the S&P 500 had technically hit that negative 20% mark around then. Plus, specific worries about the corporate bond market rising default risks, and you saw investors shifting towards safer things like short-term treasuries.
So, understanding the cyclical framework we've just discussed, it helps us see these warnings not just as scary headlines, but maybe as data points within the bigger picture.
Exactly. Where might we be in the risk cycle if investors are fleeing to safety? What does concern about corporate bonds tell us about the credit cycle? Knowing that peak optimism is dangerous, that fear creates opportunity, that credit problems can be a major driver. It gives you a framework to interpret these current signals rather than just reacting emotionally.
It changes how you process the news.
Totally. It moves you towards analyzing your position within the likely cycle.
So looking back over this whole 20-year arc, the journey reflected in these sources seems pretty classic in a way. Starts with maybe being a novice, getting caught up in the easy times, getting burned,
Learning painful but necessary lessons through the downturns.
and eventually developing a much deeper, more deliberate approach, focusing on the business, value, cycles, psychology.
That's the path. And the core lessons that come through loud and clear from all these sources for anyone wanting to navigate markets long term. First, you have to understand the underlying business and its potential value drivers. Move beyond just the stock price.
Second, respect the cycles. They happen. Don't fight them. Position yourself prudently within them, driven by psychology, credit, the whole picture.
Third, disciplined risk management is non-negotiable. That includes cutting losses to preserve capital. You need that capital for the next opportunity.
Fourth, self-awareness. Understanding your own biases, keeping your emotions in check during volatility. It's fundamental.
And finally, fifth, the power of acting counter-cyclically. Being careful when others are greedy, finding courage when others are fearful, that can make a huge difference over time.
It really brings to mind that Howard Marks quote, "Experience is what you got when you didn't get what you wanted."
That's perfect. Those tough times, those losses on the early roller coaster, that's where the real lasting lessons came from. That's the experience that shapes a better long-term investor.
So as we wrap up, here's maybe a final thought for you, the listener, to chew on, reflecting on these past 20 years and looking ahead.
Okay.
If we accept that human psychology, our collective swings between greed and fear, is such a primary driver of these market cycles, and that these extremes seem pretty much inevitable, how do you, as an individual investor, consistently apply these rational, hard-won lessons when the market's emotional tide is pulling strongest in one direction? Does true long-term success require this constant battle against your own ingrained emotional responses and the overwhelming sentiment of the crowd?